Well, hello and welcome everyone to the latest session of Insmax Insurance Brokerage's Thursday webinar series. As a reminder, we host these every other Thursday at 1 p.m. Eastern. We try to keep you up to date on different ideas and industry trends. And today's concept is on life insurance with specific riders that can assist your clients with chronic and critical illness should the need arise. So with that, let's tell you a little bit about Insmax Insurance Brokerage for those of you who are unfamiliar with us. Insmax has been around for more than 20 years. We are an independent insurance brokerage. We have been representing more than 30 insurance carriers and have a longstanding relationship with them through our association with Advantage Insurance Network and other groups. Our main job for you is to help you with ideas, product, consumer materials to help you with the sale. We want to help you do business with these insurance companies by expediting contracting and licensing with these carriers, because sometimes I know it can be a bit daunting. We have a simple one signature process through an electronic platform that can make that happen for you quickly and easily. One of the other strengths that we have is decades of experience with assessing cases before they even get to the carrier. Our pre-underwriting questionnaires and our ability to ask carriers qualifying questions can help target the right product for your client, not necessarily put your clients through multiple carrier assessments formally. We can do this all without invasive exams, just by getting some information from you and them. That's kind of our service to you. Besides that, we can get you all the forms necessary to submit the application. Again, whether it's paper or electronic versions, our job is to make your job easier. And we handle the entire underwriting process from soup to nuts, and it will assist you in having your clients understand what they have and help you present the right product to fit the right need and goal. We are your full service insurance brokerage company that you can trust. And this way you can do what you do and we can do what we do, which is to support you. So with that, we'd like to talk a little bit about today's agenda. And I mentioned at the top of the message here that we're going to be talking about specific riders that can be added to a life insurance policy, or with certain carriers are built into it. Specifically, chronic illness riders and critical illness riders, long-term care riders, accelerated death benefit riders. We're going to give you a high-level understanding of what these things are and how they work, and what is required to trigger a benefit payment. Finally, how is the benefit paid? There are different ways that the carriers do this, with a deep dive on the available riders and the methods of which those riders are accelerated. We can give you a few examples of how these things work, and then finish this up with questions. And to take us through this information is Greg Leahy. Greg Leahy is Vice President of Insmax Insurance Brokerage. He's an expert in so many, many things, and we're happy to have him here to help you with this information. So Greg, please take it away.
Thanks, Larry. Good afternoon, everyone. I want to get started here by talking about some differences between your insurance of old and your new insurance. The industry has gone through some big changes in the last 10 to 15 years. Specifically, traditional long-term care products have been becoming fewer. Some of the abilities to do short pays and for the insurance companies to guarantee their portfolio of long-term care business, they've been hurt by claims experience. So we've seen products shrink, we've seen rates increase, and due to that, the life insurance carriers saw this as an opportunity, and they added new riders and features to the products to try to capture some of that shrinking market share. And what we have now are permanent products that have living benefits. Almost every permanent product has some form of benefits, and that's a good thing and somewhat a confusing thing, because now we have riders that differ from carrier to carrier and various combinations of different rider types, benefit types, acceleration methods, terminology. It's just a little bit confusing, and we're here to try to take out some of that confusion. So let's talk about what the different rider types are. First type is what we call a true long-term care rider. This is IRS Section 7702B. It is filed as a life and health insurance contract, and it's generally income tax free. You can market this as a long-term care insurance policy, but there are some differences here that we need to be made aware of. Specifically, the benefit limitations here are temporary. They don't have to be permanent, but you do have to pay an additional premium up front to have this type of rider. So it does give you more benefit. You don't have to have a permanent long-term care event, but you have to pay up front. The second rider would be your chronic illness rider or your 101G rider. This type of rider allows somebody to take distributions from a life insurance contract, specifically access the death benefit, if they are designated to be chronically ill, and they can receive that benefit tax-free. You're not supposed to market these types of contracts as long-term care riders. It's common in the industry for people to generically market all these types of riders as long-term care, but there's a very big distinction. This type of rider is a chronic illness rider, or what they call an accelerated death benefit rider. You need to have a permanent condition for most of these riders. They changed the rules on this about 5 years ago. Some carriers have a permanency requirement, some do not, which makes it even more confusing for people trying to distinguish between different products. And there's going to be an upfront charge with these types of riders, but that also varies from carrier to carrier. If there is not an upfront charge, you're going to have a discount at the time you take your claim. So what I did here is I have a summary, the different rider types to try to make it easier. A 7702B, you need to have a long-term care license to sell this because it is technically a long-term care policy. There is an additional premium charge. Your discounts are not, or your benefits are not discounted, and the condition does not have to be permanent. So this is your more robust type of rider. The chronic illness rider, you don't need a long-term care license to sell. If you pay an additional premium, your benefit is not going to be discounted, but your condition must be permanent. Most of them have a permanency requirement, some of them don't. And then finally, you have your built-in riders that Larry mentioned at the top of the call. These don't have any additional cost. You don't need an LTC license to sell it, but when you go on claim, then you're going to have a discounted benefit, and your conditions usually need to be permanent. So what triggers these benefit payments? You have to be unable to do 2 out of your 6 activities of daily living, which would be bathing, dressing, eating, transferring, toileting, and being able to control your continence. Or the clause that trumps all of them would be having a severe cognitive impairment that requires substantial supervision. So think Alzheimer's or dementia. Somebody needs to be monitoring you to make sure that you don't harm yourself. For a chronic illness rider, again, these are generally supposed to be a permanent condition. A long-term care rider could be temporary. You could have something incapacitate you for several months, but the doctor has the expectation that you will recover. You can still go on claim if it's a long-term care rider. Now let's talk about benefit types. There are 2 types of benefits. First one here is reimbursement. This is going to pay for eligible long-term care expenses that are incurred by the insured, and they're only limited to the policy's maximum monthly benefit. So the insured is going to pay out of pocket, and then they get reimbursed for the expenses by the carrier as long as it is a qualified, eligible expense. This type of benefit can pay up to the current IRS per diem limit, which is $400 per day. And sometimes you can exceed that without tax consequences because you're actually experiencing those expenses. The long-term services must be provided by a licensed healthcare provider in order to be eligible. So you can't have a family member, caregiver, or any type of informal care. It has to be by a professional.
Hey, Greg, this is Larry. If you would stay on that slide real quick, I have a question for you.
Sure.
When it comes to reimbursement, it says, the insured pays for care out of pocket. Um, isn't it true though that can happen, but that some of the carriers can make arrangements with these providers to sort of handle the bills directly so that, a loved one wouldn't have to go through that process?
That is correct. Some companies do allow you to assign your benefits to a facility, and they have care coordinators that will work with the facility and manage your monthly receipts. You're right. So your family members don't have to be burdened with that while you're on claim.
I think that's a real important distinction because it sometimes gets lost. And it's nice to have another person on the end of the phone that you can reach out and call with questions about your care. And many times, certain carriers have this dedicated team that you can use. So I just wanted to point that out for the listeners here as an important feature of reimbursement. So please proceed. Thank you, Greg.
So the second type of benefit is the indemnity benefit. This is going to pay based on the policy's monthly maximum benefit, regardless of whatever kind of incurred expenses you have. There are no receipts required, no restrictions on how you use the benefit, and the excess benefits that you don't need for care, you can use for any purpose. Buy a TV or help make improvements to the house, whatever you want to use it for. You can even use them to pay for a family member caregiver. A lot of times you might have a spouse or a child that will take time away from work to come help take care of you. And this is a way that if you have an indemnity policy, you can help pick up the lost income and provide that to the family member. Most carriers are going to limit this to the lesser of the IRS per diem limit, which is currently $400 per day. And they're going to give you a percentage of your death benefit, standard percentages 1, 2, or 4%. So let's switch gears here now and talk about the acceleration methods. So we know what's going to trigger the benefit. We know whether you're going to have reimbursement or indemnity, but how much of your death benefit is going to be reduced when you go on claim? And in a dollar-for-dollar acceleration, it's pretty straightforward. You're going to pay an extra premium up front, and because of that, you're not going to have a discount. They're going to give you your benefits dollar for dollar. So if you have a $500,000 death benefit, you take 1 month of $10,000 for your claim, you're going to have $490,000 left over for your beneficiary. And here's an example from one of our carriers. This is John Hancock. And this shows that at the age of 85, if you have a claim and you're getting $10,000 per month, you can see you're going to receive $120,000 per year from the policy. And then you also see that your death benefit is reduced dollar for dollar. It's going down $120,000 per year until it's pretty much used up and you've got a de minimis guaranteed policy. The second method would be an actuarial discount. This is where you get a present value based on your life expectancy. You didn't pay anything up front for this type of rider, so they're going to give you less when you go on claim. And the example here would be a $500,000 death benefit, the same $100,000 acceleration, but you only receive $9,000 if you have a short life expectancy. The longer your life expectancy, the less you're going to get from that monthly acceleration because they have to discount it over a higher number of years. So if you have a long life expectancy, it could only be $6,500. And this could be the difference between going on claim for Alzheimer's or dementia versus going on claim for something like congestive heart failure or something that's going to drastically limit your life expectancy. And the most important point here, you're not going to know what you're going to get until the time of claim because you don't know what condition is going to cause you to go on claim. There's no way for you to know what your benefit will be up front. Here's an example of an accelerated discount. This policy, you're going to request $125,000, but because of the discount, you're only going to receive $98,000 in the first year. And as you get older, you get slightly more because your life expectancy is less. But you can see that your net death benefit is still reduced dollar for dollar, but what you get in your pocket is discounted. So let's switch gears here now and talk a little bit about critical illness riders. So Chronic illness is going to pay you for 2 out of 6 ADLs or the cognitive impairment. Critical illness will provide a benefit for heart attack, stroke, cancer, a major organ transplant, blindness, diagnosis of ALS, end-stage renal failure, and several other niche conditions that we didn't mention here. But the benefits are usually going to be discounted. They'll be provided as a lump sum, and the benefit amount is going to vary based on the severity of the condition. So here we've got a policy where I'm going to highlight 3 different benefits. We've got a terminal illness benefit. So if the doctor tells you that your life expectancy is 12 months or less, you could surrender or exercise the terminal illness rider and receive a lump sum of $405,000. If you have a chronic illness event, you'll notice that these monthly benefit amounts get larger as you get older, and that's because your life expectancy is lower, and they're discounting your monthly benefit by a fewer number of years. And then down here, what we're talking about, the critical illness, you can see at different ages, depending on different severities, you're going to get a different lump sum. So the higher the severity, if it's a life-threatening event, you could receive over 80% of your death benefit as a lump sum after a triggering event. So let's look at a couple of case studies now and show you how we sell these types of riders to clients. Case study 1 here, we have a client. We call this the use it or lose it. 60-year-old female, Susan, she's approaching retirement. She has seen what a long-term care claim can do. She's been helping her mother, and she's interested in long-term care insurance for herself. Her concern is that if she buys the long-term care policy, she may be wasting the money if she never goes on claim. So what are we looking at here? A traditional long-term care policy versus a universal life policy with a chronic illness rider. The same benefit pool, $500,000, same monthly benefit, $10,000, but you'll notice that the premium payment for a traditional policy is $5,500 per year with no death benefit, and the premium's also not guaranteed. They can raise the rates each year, and that's a common thing for a traditional long-term care policy. But with a universal life policy, you have a premium that's about $3,300 more, and you get a death benefit that's guaranteed and a premium that is guaranteed to never rise. So we tell the clients that are afraid of losing their money, if you pay a little bit more and they understand the value, that they can get a guaranteed benefit, and if they happen to die without ever using it, that money's there for their family. And lastly, the policy is going to build cash value. So that incremental $3,300 more that she's paid, there's going to be well in excess of that in the policy if she ever decided to cancel it. So she's still in a better position. Case study 2 here, this is for policy review. So Michelle, she's 55. She's got an existing whole life policy. She's been paying this thing for years. It's building up cash value. But as she's thinking about retirement, she's wondering, how can she keep the death benefit and can she stop paying? She sees the cash in the policy, but doesn't really need the cash for the retirement. So what we show is that the existing whole life policy, she's paying $3,000 per year. It's got $105,000 of cash value, no long-term care rider or chronic illness rider because the policy is more than 10 years old. The premiums are guaranteed, but they're larger than what she could get with a new policy. And we show her a 1035 exchange with her cash value into a new death benefit. The premium payment is $1,900 per year, so we've lowered her premium payment. And she adds a $10,000 per month chronic illness rider with the guaranteed premium. And the great thing here is that because there was so much cash in that whole life policy, she only has to pay the new premium for 4 years, and then she's done paying. So we're able to accomplish 2 of her goals, maintaining the death benefit, reducing and stopping the premium, and then in fact we've added the chronic illness rider on top of it, all while providing the same chassis that's going to build cash value in case she ever needs it. And here's our last example here, bundled savings. So this is Raj, he's 50. He wants to protect his family, wants to also leave a legacy, but he's looking for the cheapest way to do this. And this is a pretty common sale. We've got somebody that's just looking to buy a guaranteed universal life policy. Cheapest one out there in the market was $5,448. No long-term care or chronic illness rider, but it does have a guaranteed premium. And for just slightly more, we can get a guaranteed policy, same death benefit, for $403 more that provides $10,000 per month chronic illness, and it has a guaranteed premium. So we compare this to what it would cost him to buy a traditional long-term care policy. If he wanted $10,000 per month from a traditional policy, it would be $1,700 per year. So $403, that's a 75% savings over what it would have cost him to buy that as a traditional policy. And he likes the value, and it's just a small increase over what he was about to pay. But let's switch gears again, and let's talk about living benefits on term. It's not just for permanent policies. All of the examples we've been talking about here have been permanent. There are even more changes in the industry that are now allowing these riders to be on term policies. And in this example here, we've got 5 different companies that are very similar premiums monthly, and the difference per month is $5.87 between the cheapest carrier and a carrier that has a living benefit rider. So if you tell somebody the story of you can get access to your death benefit if you have 2 out of 6 ADLs, a chronic cognitive impairment, if you have a heart attack, stroke, cancer, organ transplant, a number of other conditions, or if the doctor tells you you're terminally ill, you can get a large percentage of your policy, more than 80% for a qualifying event. That's a value that I think anybody would say, well, I'll pay $5 a month for that. It's just a phenomenal tool here, and we've got multiple products with multiple carriers. Life insurance with living benefits, accelerated death benefits for limited life expectancy, long-term care with the chronic illness rider. These are fantastic benefits that you can provide that don't cost too much, or your clients can see the value. There's plenty of ways to position this. I don't know anybody that doesn't know someone that's had a heart attack, stroke, or cancer, or experienced a family that doesn't know someone that has dealt with a long-term care claim. So